I think this might be one of the biggest investing mistakes that I see people making with index funds, and it happens all the time. I get the same questions on my Instagram, here on YouTube, and even over email. I also made the same mistake when I got started many years ago, so I thought it was about time that I made a video talking about this directly. I'm going to show you what the problem is, explain why it's an issue, and then give you an idea on how you can fix it moving forward. Okay, so here's the problem, and I think it's best explained by showing you how you can easily fall into this trap. Let's say that you've started investing quite recently because you've watched some videos here on YouTube, maybe even some of mine. You opened up an investing account, you put some money in, and you decided that you want to invest into an index fund. Let's just say that you pick the S&P 500 as your index of choice because it's the most famous one, everyone talks about it, and you've seen all of those people talk about how you could have been a millionaire if you would have just invested a few decades ago with a little bit of money. Anyway, you get off to a good start and then you keep putting in the same money every single month to your investing account, exactly as you said you would do. So far so good, no problem here. But then after a few months, you decide that you might want to add something else to your portfolio. You've got a lot more confidence now, and you realize that investing isn't as scary as you first thought it was. And you saw another video saying that the S&P 500 isn't diversified enough. So you decide that you want to add in a global index fund into your portfolio. You take a pick of all of the ones on the market, and then this month you decide to put your money into that fund on its own to try and balance things out so you've got money in both of your funds. You keep doing this for another few months and you're now trying to balance investing in both, choosing to put about 50% of your money in each one. You're feeling pretty good about investing so far, you're investing all over the world and you've now got a lot more confidence too. You also keep watching those YouTube videos and now you're really deep into the YouTube finance rabbit hole. At this point, you want to add some more investments because you don't just want to make money slowly, you want to go all out on growth. You've heard about another index called the Nasdaq 100, which has all of those famous tech stocks that everyone loves. So yet again, you decide that you'll add this index into your portfolio and choose a fund that tracks that. At this point, it's a bit harder to decide how much of your money you want to put into each investment every month. So you just kind of choose a number and you think that makes sense. Then finally, a few more months pass and then you add in another fund tracking the price of gold, as you've not got that in your portfolio and everyone says that you should at least have a little bit of that. Now, what you end up with looks very different from what you started with, yet you're still using index funds. So in your head, you might be thinking, well, this is exactly what everyone talks about. Low-cost index funds, passive investing, and then just set and forget. However, let me show you the problem here and explain why I think this could be a bit of a trap that investors are walking themselves into. Benjamin Graham, a very famous investor who heavily influenced Warren Buffett, said something that I think is going to lead us very nicely to this problem. He said, the investor's chief problem and his worst enemy is likely to be himself. Think about this. Staying with the example we've just run through, you've now got a situation where every single month, this investor is now having to decide how much of their 100 or 200 pounds will go into each of their different funds. They've got an S&P 500 one that they started with, a global index fund, the Nasdaq 100, a gold fund, and maybe I'll just throw in another one to highlight the issue. Now, newer investing apps make it really easy to have lots of different investments, and I'm all for having lots of choice and low costs. However, the issue here is that you're now going to have to decide what percentage is right to put into each of these investments. Now, there's no right or wrong answer here, and that is part of the problem. I, or anyone else, cannot tell you what investments are going to be best this year, next year, or 20 years from now. And nobody can tell you what level of risk that you're going to be happy to put up with. You see, that's the first problem here. And if we just go back to Benjamin Graham's point, you are going to become your own worst enemy when it comes to investing. Do you put more of your money into the funds that have done well, or maybe you put more money into the ones having a bit of a dip? Do you try to make them all have an equal amount of your money, or do you change your investments every single month? I have no idea, and I'd argue that nobody knows. So therefore, I try and avoid this problem altogether. I'll explain what I think the solution is in just a moment, but let me first go through the second issue. So now that you've got yourself 4 or 5 different funds in your portfolio, and you've roughly decided how much you want to invest into each one, you start to run into this next issue. Here's a quick example. Inside an S&P 500 index fund, you've got 500 of the largest companies in the US, which are all organised by their market cap weight. Now, this is just a fancy way of saying the larger the business, the more of that fund will get invested into that company. So on screen now, here you'll see what the current largest companies are and how much percentage of the fund is invested into each one. The top companies in order are Microsoft, Nvidia, Apple, Amazon, Meta, and so on. Now, for every £100 that you invest into an S&P 500 index fund, you'll get this amount on the right. So £6.70 would go to Microsoft, £6.60 into Nvidia, and so on down the list. When you invest into an index fund, you don't have to worry about deciding how much of your money to invest into each of these 500 different companies. You're basically leaving that decision to the market itself. If Microsoft stays as the most valuable company in the world, then it will keep getting more and more of your money. If it falls behind and another one overtakes it, then it will start to get less and less. This is basically the whole idea of passive index fund investing. You just invest in the entire market, or at least most of it, leave the prices to do what they want, and then you benefit over the long term. Now, it doesn't guarantee anything in the future. Let's not pretend that it's magic free money. But it does mean that you'll get whatever the average returns of the market will be. And let's not forget that the average market returns are far, far better than most investors ever get in their investing lives. Now, if we put together a portfolio from earlier, let me just show you what's actually inside. Now, here's the percentages that I'll choose and the different ETFs. This is just for an example, don't go copying this. I'm just a guy on YouTube making videos about investing, and I'm not your financial advisor. But just out of interest, here's now what a portfolio like this will actually look like. Lots of the names are going to be exactly the same, which should not really surprise you. But what is different is the weights, and this means that you will be putting your money to work in a slightly different way. If I put them up side by side, comparing the S&P 500 to this portfolio, let's have a look at how things would actually be. So you can see you'd be putting more money into Microsoft, more into Nvidia, more in Apple, less into Amazon, more into Broadcom, and so on. Now, this throws up a big issue in my opinion, as basically what you're now doing is actively investing, which is the opposite of what you might have actually started trying to do. The more and more you move away from market cap weights, the more and more you become an active investor. You end up being your own worst enemy, as you now have to decide every time you invest what percentage is right, whether you should add even more investments, and how long you stick with this thing. We know from history that the more often people trade back and forth, the more likely they are to lose money. And we also know that those people who don't think long term will also end up with far less than those who stick with the plan. Now, I'm not going to pretend that this is somehow the end of the world, and if your portfolio looks like this, it's a bad thing. Like I said before, I have no idea what investments are going to do well in my investing lifetime, and I also know that nobody else knows either. I mean, there's no reason why this complicated portfolio could end up doing better than just a single index fund. Over the years, you might end up getting an extra 0.5% here and there, and with the effects of compounding, you could end up with tens of thousands more. However, just as equally, you could end up performing worse, and before you know it, you've cost yourself a lot in returns. There's no way to know at all, and that is just part of investing. It makes it exciting, annoying, frustrating, you name it. It's everything you can imagine, and you can throw a few swear words in too. So what do you do, and what's the solution? Now, I'm guilty of this mistake, and I've fallen into it many times in the past. I think the solution is in two parts. Firstly, investing is all about being intentional and understanding what you're investing in. Going back to the start of this video, I showed the example of someone new to investing who wanted to invest into an index fund, and they kept things really simple, choosing something like the S&P 500. By doing that, they let the market decide the prices, and they can focus on much more important things in life. Once they start to add in other index funds, I'd bet that they can't really explain why they're doing it and what the purpose is. For example, if you add in the Nasdaq 100 to the S&P 500, all you're doing is putting more money into the same companies. The Nasdaq 100 is a really concentrated list of technology stocks that are listed on the Nasdaq exchange. It's got Apple, Microsoft, Nvidia, and Amazon, many others, all of which are already in the S&P 500. Following on from that, all of those companies are also found in a global index fund. The only difference is how much of your money is concentrated in a much smaller number of companies. The point I wanted to make here was that if you are going to add lots of different index funds and lots of different investments, that you really need to know why you're adding things in and what they're for. If you want to add in a fund for more diversification, then that's fine. Just make sure that the fund actually has different kinds of investments. Otherwise, this defeats the point. For example, if you want to diversify an investing portfolio that only has the S&P 500 in it, then you might want to look to buy an index fund which covers Europe or maybe even the emerging markets. This makes a lot more sense, as none of the companies inside of those funds are going to double up and overlap each other. Likewise, if you only own an index fund covering the UK, like the FTSE 100, then you might want to look at something like the S&P 500 to give yourself some more exposure to the US market. There's a million ways you can invest, and there's no right or wrong way, but there is a right and wrong way for you. And I think it's really important to find out what it is and make sure that you really understand what you're investing in and why. The second solution to this problem is making sure that you keep focused for the long term. I'm sure that you've seen a million videos on YouTube talking about the fact that if you'd started investing in the stock market 30 years ago with a few £100 or whatever it is, you'd be a millionaire today. However, if it was that easy, then why doesn't everyone do it? The reality is that it's incredibly hard to think long term and commit to something that is potentially decades away, and we're just not wired that way, and it requires a lot of effort. Going back to the portfolios that we've spoken about earlier, it almost doesn't really matter what investments you choose if you're sticking to index funds and being well diversified. But I do think that if you end up making a portfolio that you can't stick with and you keep changing, you're going to put yourself in a very difficult position. I think this is particularly important when the stock market has a crash or correction, like it did recently for all of the tariff chaos. When this happened, lots of people were second guessing themselves and questioning if they should stick with their portfolio or make some short-term changes, waiting for things to blow over. The problem is nobody knows the future, and nobody knows when a good time will be to buy back in or go back to your old strategy. If any of us knew what the future held, investing would be super easy, and we'd also be the richest people in the world. So, in my opinion, I think the best thing you can do as an investor is to stick long-term with a portfolio that you can actually live with. Doing anything else is going to make you your own worst enemy, just like Benjamin Graham said. Now, if you need any inspiration or help getting started investing and choosing those investments, don't forget that I've made loads of videos on my channel to help you get started, including this one, looking at some of the most popular funds that you can have a look at. I'll see you in the next video. As always, happy investing.